So what I'm going to do is talk a little bit more about, as we start here, funding buy-sell agreements, because they're such a critical part of, we think, farm planning, farm transition planning, and then how life insurance works and that kind of thing. So the advantages of, Susan talked about cross-purchase and stock redemption buy-sells, and that you can have, you have two choices. You have cross-purchase funding typically in any event, which is always easiest to have the life insurance outside of the corporation. If you have life insurance in the corporation, you can run into issues where you don't have enough basis to get it out, or you might have a taxable distribution getting the proceeds out. So to the extent you can have it on the outside, it's always easier, less tax complications putting the insurance on the outside. But the problem with that is that if there's more than just two owners, you have multiple policies. In other words, if there's three owners, then each owner has to buy two policies, one on each of the other owners. And it grows. So it's, if you had four owners, each person would have to buy three other policies, so you'd have 12 policies for four owners. And by using a partnership to hold the policies, you can simply have one policy per owner, and yet it's outside of the corporation, so it's funded as though it was a cross-purchase, and you get all the tax benefits of full basis step up on that. You do need to include a provision in the documents, which your attorney would do, that would special allocate the death benefit just to the surviving partners, but that's easy to do. So what you end up doing is sort of combining the benefits of cross-purchase and stock redemption. One of the reasons you don't want to put insurance in a corporation is if it's a C corporation, it can be subject to alternative minimum tax if it's a larger policy. Susan already mentioned the basis step up. The other thing that happens is if you have a cross-purchase arrangement, if Susan and I entered into a buy-sell agreement, she's so much younger than me and, of course, female and healthy, I would have much less premiums to pay than what she'd have to pay on me. And so if we put it in an entity that's a partnership, we can allocate the premiums however we see it's fair. And a lot of times that's simply the company pays all the premiums. And I'll talk a little bit about transfer for value when we get into the nitty-gritty, but partnerships avoid any concern that we turn the death benefit into taxable income. The question is, and I'll repeat it since we're being taped here, the question is, if a father-son have an LLC together, can the LLC own the insurance and pay the premiums and still have the death benefit out of the, I presume, father's estate? And the answer is yes, that works real well. What you have in an LLC is taxed as a partnership. So any entity that's taxed as a partnership, an LLC, an LLP, or an actual partnership, we can put what's called special allocation provisions in, and we would do that so that any life insurance income, you can allocate in a partnership entity, you can allocate different types of income to different partners as long as there's an economic substance to that. In this case, there would be. So you would say that it would simply say any death benefit received by the partnership or the LLC due to the death of an owner would be allocated just to the surviving owners. In this case, there would just be two. If the dad died, the only surviving owner would be the son, and it would all get allocated to him. So it would all flow to him, and it would not increase the value of dad's partnership because it's allocated just to the son's capital account. So it actually works nicely. The question is, if we do set up a partnership just for that purpose, does it need to be engaged in business activities? And if you look at the tax code, of course, a partnership is the fallback entity. If it's nothing else, it's a partnership if it's owned by more than one person. And so and actually I did quite a little research of that early 90s in terms of whether that would need any other business purpose. And I think the general consensus is that business continuation in owning the insurance is sufficient business purpose to make it a partnership. As I said, it's going to be a fallback entity, and that might even be easier nowadays that we have the check-the-box rules for what kind of an entity you want it to be taxed as. Having said that, we also have situations where a lot of times there already is a partnership in place or an LLC. Sometimes people have put some of their real estate, whether it be a farming operation or others, in an LLC, and there isn't any reason you couldn't use that as the funding partnership. You could just put the life insurance in there, put in a special allocation just for life insurance, as long as all the parties to the buy-sell agreement are also members of that LLC. So that should work. We already said if there's more than one owner, we need multiple policies unless we put it in a partnership. Cash value accumulations, if you wanted to do that, you can use a permanent policy in the partnership and then get it directly into an irrevocable trust later without it being a distribution to the partner and then a contribution and subject to the 3-year rule. To switch from stock redemption, if you do have policies in the corporation, you can't switch them out to the other owner of a corporation without it violating the transfer for value rule and making the death benefit taxable unless there's a partnership in place. So that allows you to maintain the existing policies. And as I said, when a partnership already exists, you can just use an existing partnership. Good question. The question is, well, if it's a separate entity outside of the operating business, how do you get the money over there? And there's a couple ways to do it. Obviously, if it's an existing LLC or partnership, you simply, and if there is enough rents being paid, or if you can increase rents without being outside of the fair market value rents, you can do it that way. If not, or if it's a standalone partnership, you can just have the partnership pay it and treat it as a distribution from the corporation to the partnership and a contribution of capital to the partnership. So it would be a distribution to the shareholder, I'm sorry, and then a contribution of capital to the partnership. And that can be whatever percentage you want to. If it's treated as a distribution, you pay, if it's a 10-year term or 20-year term, you pay, essentially the insurance company averages out the premium, and you pay a guaranteed level premium for that term. And at the end of that term, the policy either ends or gets so expensive you don't pay the premium anymore. Very straightforward. Then there's whole life, which is what a lot of people sort of think that's the other alternative, is whole life. But there's a number of different types of permanent policies. People buy whole life insurance, and a whole life policy is kind of a black box where you put premiums in, and there'll typically be some dividends that are paid, and then at the end there's a death benefit. But what happens with whole life insurance is the way that whole life insurance premiums are calculated, they're based on everything being guaranteed. So whole life insurance, if you bought a whole life insurance policy that was all base policy, in other words, all whole life, it would be a very expensive policy. And that's because it's based on the guaranteed insurance rates. There's a standard mortality table that all insurance companies must use for their guaranteed mortality, in other words, their maximum mortality in that policy. And that table was republished in 2001, and if you want to get a policy approved in Wisconsin by the insurance commissioner, you have to use that table. So that's the table that everybody uses to price their whole life. That's how whole life works. And so what happens is you say, well, but we have dividend performance because our actual charges, the insurance company underwrites people. As you know, you have to take a physical, and if you're not healthy, you might not be able to get insurance, or they might charge you more. Well, by doing that, the insurance company then can keep its mortality table somewhat below, actually quite a bit below, that guaranteed table that the policy is based on. So what that means then is somewhere in between, we've got less than the guaranteed. So if I price a policy based on everything being guaranteed, and we do better because our underwriters are smart and do a good job of underwriting, then there's going to be some dividends. And so when you're talking to your agent about that premium, and the agent said, okay, well, it's a $1 million policy and it's going to cost you $34,000 a year, and you nearly faint, the agent says, well, we can cut that down to about $15,000 a year. Well, what they're going to do is they're going to say, we'll sell you a $400,000 whole life policy with a $600,000 term rider on it. And that term rider then will be replaced by the dividends. So initially we'll pay the term when you buy the policy and you're young and healthy. The term rates are not that high. And as we have dividends, we'll buy paid up additional insurance to eliminate the term. What the bottom line is, that ends up producing some risk in the policy, because if you don't have as much dividends as we thought, either because interest rates drop or because the company's mortality experience generally or on that particular block of policies goes up, you end up with maybe not as much dividend performance and the term doesn't get replaced. And then as you grow older, the term charges within the policy will continue to build. And at some point, you won't have enough at the current premium level to pay that term. So the term will either drop off or they'll ask for a much larger premium. Now, I said insurance is simple. There's really only 4 pieces to insurance when you look at it. Any of these policies, except for the term, that grow cash value, there's the premium you put in is a positive. There's a mortality charge, which is the risk element, the chance of you dying. It usually comes out of the policy cash value on a monthly basis. So that charge is based on your age and how much insurance risk there is in the policy. Then there's an expense charge, which is an administrative charge, and there's a maximum on that too that's allowable. And then those are the 2 negatives. The premium's positive, the mortality and expense are negatives, and then the positive again is any interest earned on the cash value that's in that policy. So that's it. That's all there is to it in a policy. What happens though is both the interest side, well actually interest side and the mortality charges can change quite a bit, and then they can change the expense side a bit too. They don't have as much room on that. But what will happen is if you look at the policy and you say, well, by paying my $15,000 a year, that ought to carry my $1 million policy, because we, at our current dividend rate, we'll be able to replace that policy with that term element with paid up additions. If the rates drop or the mortality charges go up, the policy might not make it. So what we always do with people is say, let's just go back every five years or so, depending on how long you've had the policy, and just have the company re-illustrate. They can send you, and when you buy a policy, you usually get an illustration that shows year by year how much the cash value and the death benefit might be. Well, they can re-illustrate that. It's called an in-force illustration. So if you call your insurance company anytime and say, I'd like to get an in-force illustration, because the policy's in force now, they know exactly what that is, and they'll send it out to you. And it'll look the same. It'll be year-by-year calculation of what the guaranteed and projected cash value and death benefit will be, and premiums if they change. Only it starts with, instead of year 1, it starts with year 20 or whatever year we're in the policy. But that's a good way to sort of understand, is this policy going to make it, or is it going to run out of gas? Because we see this happening quite a bit. Now so I've covered the whole life and the blended whole life. Universal life is something that just came out because with an insurance, with a whole life policy, if you're trying to change the premium, you have to blend out. If you said to that agent, I don't want to pay $15,000 for that $1 million policy, he might come back and say, well, how about $12,000? Now it's going to have $300 of base and $700 a term. Obviously, that makes it more risky. The more you do that, the less you pay up front, the more risk that it's not going to work, and we'll have to increase the premiums later on. Somebody in an insurance company probably in the early 80s, maybe it was the 70s, said, why have all this complication of having a whole life policy where we have to blend term and not in it? So they created universal life. And universal life is simply a policy that says, rather than have a set premium for an amount of death benefit, let's just say that they can pay any kind of premium they want, and we'll just put excess cash into the cash value. So if you bought $1 million whole life policy, it would be $1 million policy, and you would pay, there would be a monthly charge that would come out for the $1 million of risk. You would put your premiums in there, and they would take their charges out every month. And if you pay another premium next year, they'll take their charges out any month. At any month there's a cash sitting in there, they will pay interest on that at whatever the rate is. So it makes it simpler. You don't have part term and part whole life. You just simply have a policy that's just a set amount of death benefit. And the charge is always the difference between the amount of cash and your total face amount. So in other words, if you have this policy that has $100,000 of cash value in it, and it's $1 million policy, your insurance charge for that month is only going to be based on $900 of coverage. Because if you die, they've already got the $100 of cash. So their risk element is only $900. So that's how these things work or don't work, because that $900 is charged based on your age. So it's not the age you took the policy out at. If you take the policy out at 40, and you've had the policy for 40 years, the internal charge on the amount of insurance in that policy, they're going to charge you for an 80-year-old, because that's how old you are now. So what has to happen is, that's why there is cash value in life insurance, because when you think about it, that insurance charge is based on the chance of you dying that year and the amount of risk. Well, if you have a $1 million policy with no cash on a 99-year-old, the chance of dying the next year is getting pretty high, and so the insurance charges will approach the death benefit as you get close to the end of the mortality table. So you have to have the amount of insurance, as the cost goes up, the amount of coverage has to be dropping, and that's why there's cash value in all these policies, because it keeps the whole thing working. So as the rate gets higher, as you get older, it's being paid on lesser and lesser amount. In other words, if you have a typical $1 million policy, the cash value will be approaching $1 million as you get to age 100, because otherwise the insurance charges will eat up that cash value so quickly. Having said that, if you order an in-force illustration for your existing policies, and that's what we would typically do, is if you wanted us to take a look at your existing policies, we'd say, let's order an in-force. And that in-force illustration will show the cash value either growing year by year or declining. And what happens is, if you see the cash starts to decline, then you need to address that policy and do something, either increase the premium or reduce the death benefit or something. Because when you think about it, take an example where you have a policy that is a $1 million policy with $400 of cash. That means we're paying insurance on a $600,000 risk amount. So a year later, maybe we have $420,000 of cash. So that next year, we're a year older, so our table rate's higher on the mortality, but now we're only paying on $580. So you can see how that will, as long as the increase in rate charges is offset by the decrease in the amount of insurance because the cash is growing, the policy will work fine. But as soon as it turns and you have the cash dropping, then you have a higher charge on a higher amount. And so if the cash value drops a little bit one year, it'll drop more the next year and even more the next year. So they'll run out fairly quickly. So one of the things that we would always do is take a look at anybody that has existing insurance, and I should go back to where I was. Where was I? So the things we ask when we look at insurance is it still needed and will it last? So by getting an in-force illustration, we can look at whether we need to do something with it. But in the same breath, we're going to say, okay, maybe we need to increase the premium on this because it won't last. Well, then the obvious question is, do we need to increase the premium because do we care if it lasts? In other words, do we still need the insurance? And the question that we see for most folks when we're looking at business transition and estate planning is if we don't need it for the buy-sell agreement, which, as Susan mentioned, is really part of the overall estate plan, maybe we don't need insurance anymore. Estate taxes used to be a big issue from an insurance perspective, but nowadays it takes a lot of land. Now there's still a lot of farming operations that are worth more than 10 million, or it's going to be almost 10.7, be over 10 million 7 for a married couple before they're subject to the federal estate tax. So if you're over the 10 million of net worth, there's a pretty good chance you could be subject to significant federal estate tax. That's at 40%. But if you're not, maybe you don't need the insurance. Susan also sort of mentioned that a lot of times insurance is used for this buy-sell piece to make the estate more equal. And that's a tool where we see it used probably as much or more than we do from a estate tax perspective these days, because when you think about it, if there's one child farming and 3 that are not, and with farm values, it's not uncommon to see $5-10 million farm values just because of the values of the equipment and the land is so high. It used to be that the farms were not worth all that much, and the kids moved off the farm because they didn't want to be on the farm, and it wasn't worth that much. But nowadays, it's real money, and even if the kids say they're okay with one child getting the farm, somebody's going to have a complaint with it. It might be, as Susan mentioned, it might be the in-laws. But somebody's going to say somewhere, geez, look at, he got $8 million farm from your folks, and you got a couple $100,000 worth of whatever was left, the lake place or something. So one of the things that you can do, and that's where we see putting it into a buy-sell plan first. If you do have a buy-sell agreement with the child that's farming, that requires that child to essentially buy the farm from the heirs, then the estate can distribute out more or less equally. And that's where, if you put some insurance on the mom and dad, and here's where it can be insurance on one of the parents or both of the parents, depending on which is less expensive. And a lot of times we'll do joint insurance on the parents so that they can save some premium dollars and then have the child that's going to continue the operation own that policy. That eliminates the need for an irrevocable trust, and it also keeps it out of mom and dad's taxable estate. Because what we don't want to do is buy insurance for the IRS. If we looked at the estate tax rates that we heard about in Tammy's presentation, or the income tax rates, we don't want to pay any more than we have to Uncle Sam. So it actually works real nicely to have that child buy some insurance on mom and dad to cover that, to be able to buy out the heirs. Now, a lot of times we look at it and say, well, how much should they buy? And that's kind of an art, more of an art than a science, because, mathematically you say, okay, it's a $10 million farm. There's one child farming and 3 that are not, so each child would inherit $2.5 million. So the surviving farming heir would need to buy $7.5 million of insurance to buy out the other members. Realistically, I don't think that happens very often. Usually there's some non-farming assets that can go to those other heirs. The surviving, first we don't know it doesn't matter what the value is today, it's the value when we're both gone. And what we're trying to do, I think, the number we're trying to get to is enough so that farm can stay intact and maintain solvency, if it happens to happen in maybe not the best year. But we're not trying to also make it like the son or the daughter that stays on the farm just won the lottery either. In other words, they don't need to get the whole thing free and clear. They can handle some debt. We just don't want to put them in a situation where they have so much debt that a bad year could sink the farm. So that's kind of the balance. Yeah, question?
Can a present life insurance policy just be changed over to beneficiary being, say, the son or the daughter that's...
Yeah, the question is, can we use an existing life insurance policy and transfer it over to the son or daughter and use that policy? And absolutely, you could. What you do have, though, is when you transfer a policy, when you make a gift of a policy, you have a couple things to think about. One of them is The transfer for value rule. That was a nice transition, thank you. When you make a gift of a policy, well, the general rule is life insurance is tax-free unless you sell the policy. In other words, if you buy a policy from an insurance company, you're buying insurance. If you buy it from somebody else, you're an investor, and then the death benefit becomes taxable income under Section 101 of the code. And a lot of times that transfer isn't completed until death. In other words, if you made the child the beneficiary in a business situation, the IRS could argue that was part of the buy-sell transaction and not a gift to your child. So you got to be careful of that piece in it. And it isn't completed if you continue to own the policy until death, because you can change the beneficiary till the time of death. So you can always change it around, so that's not a completed transaction until you reach room temperature and you can't change it anymore. So, as I said, consideration can be any part of, in a business transaction, they can find consideration anywhere. And it does make the death benefit taxable. And the reason that I had a slide for this is not unusual. This happens, I probably see this once or twice a year where somebody set something up because they said, in fact, we had a John Deere dealership that had 2 branches and they bought another branch. So they started a third location, and they brought in another business partner to operate that third operation. So instead of being owned by 2 people, it was owned by 3, and they had policies on each other. This was just a corporation, S corporation. And so they said, well, this new guy, we're transferring some of the shares to him, and we should also transfer half of the policy, half ownership of the policy that we're funding the buy-sell with to the new owner. And fortunately, I got there before anybody died, because what that does is that's a transfer, a sale as part of the business transaction, a sale of half of that policy to that new owner that came in, and that would have made the death benefit ordinary taxable income, not capital gain either, it's ordinary income. So on that case, we actually created a partnership to fund that buy-sell agreement. So it does happen, because it makes, a lot of times it makes logical sense. But you always have to look at who the owner and the beneficiary is. There's exceptions to the transfer for value rule, and that is if you make a gift of the policy. This carryover basis exception is really where the policy is gifted. And that would be the situation if you did use an existing policy, just make sure it's a gift to that child. That will work, because that's an exception to the transfer for value rule. And then the other piece that you would have, if you, in finally answering your question, is that an existing policy that is gifted within 3 years of death is brought back into the taxable estate if you were to pass away within 3 years. So if you're potentially subject to the federal estate tax, you got to be careful of that, because you would make it subject to your estate tax if you were passed away in 3 years. On the rest of this slide, the transfer to the insured, to a partnership of the insured, and to a corporation where the insured is the owner of an officer are rules where you can avoid the transfer for value rule. So that's why we use a partnership for funding these buy-sell agreements, because you avoid any concerns with the transfer for value rule. Back to where I was just sort of talking about using these policies and how much insurance we want to use is by the other thing that works well with a farming operation is you have that son or daughter own the policy, and then he or she is the policy owner, and that's who's obligated for paying the premiums, and of course that's who wants to pay the premiums because they get the death benefit. But it's also an opportunity to maybe provide for some of that equality that's, or equity that Susan was talking about in the overall estate plan. Typically what you see in a non-farming situation, if somebody wants to buy an insurance policy for their kids for estate taxes or for other estate liquidity, they typically put it into an irrevocable insurance trust. And I know these guys have drafted many insurance trusts. They're used to doing a lot of those. But then what you do is you use up part of your annual exclusion, your $14,000 per child, to make a gift to the trust to pay those premiums. And then typically the kids get that equally. In this situation, we would have the farming heir owned the policy outright, and he or she would make those premium payments. And then, so the question becomes, well, how does he or she make the premium payments? And that's going to be an interesting thing, because initially, while you're still in control and running the farm, owning it, and making the farm income, you probably want to help him or her make those premium payments. Once the farm is all taken over by that person, and they're earning it, and you're just maybe receiving rents, well, in that case, maybe they pay their own premiums on it, because it is, in fact, a buy-sell agreement to buy you out. But in those early years, you can allow that person to, maybe you pay him a little bit more salary in his or her, whatever he's being paid around the farm. You could let him sell a little bit more grain. If you're renting land to him, you can maybe lower the rents a little bit. But the point is, all of that is sort of between you and that farming heir in terms of helping the equity, but it doesn't show up in your final estate plan. So it doesn't, you can use that to sort of equalize a little bit and still have your estate more or less be equal to the remaining kids. Sometimes we see the buy-sell provisions actually in the will. I've seen a number of situations that say, I give to my son or daughter who's farming, so long as they're actively farming, the right to buy all farming assets from the estate or the other heirs. So, and sometimes it's at some value, some less than fair market value. Now, there you want to be careful too, because if it's too much less than fair market value, you end up with having your estate just be unequal. The kids, you know, if you say he can buy it at 40% of fair market value, then the other kids are going to say, well, essentially he got all of this. So, you know, some discount is expected in the family, but not 100%. How did I run out of time? This is so much fun, and it just goes so fast. Let me just see what else I didn't cover. I talked a little bit about the, where's the button here? Permanent versus term insurance. The only other thing that I alluded to slightly was the second death insurance, the survivorship insurance. We see a lot of situations where in a typical buy-sell agreement, like Susan's example with her and I, we would buy policies on each other that would pay at our death. But in a family situation, a lot of times it's okay if that surviving, that farming heir continues to be in business with mom or dad or whoever the survivor is. And you can save usually about 40 or 50% of the premium by buying second to die coverage instead of single life coverage. And that's often what's used. This is the slide I already looked at. I guess the only other point was, however we structure the life insurance, we always want to keep it, and I've alluded to that too, keep it out of the taxable estate. So I guess what I would say is I am out of time. If there are any other questions, I'll be around for a little bit afterwards. And I thank you for your time, and I'll be here. Thanks, Tom.